In this interview, I sit down with Jake Barber, head of the international financial planning firm SJB Global, to unpack the real money matters that Americans often overlook when moving to Spain. From the shock of Spain's wealth and solidarity taxes to how 401ks, IRAs, and even Roth accounts are treated once you become a Spanish tax resident, Jake breaks it all down in plain English. We also dive into US trusts, double taxation risks, and smart timing strategies to structure your wealth before your big move. Stay until the end because you're gonna be surprised by many of Jake's answers. Good morning, Jake. Nice to have you here at Spainguru.
Morning, Bruno. How you doing?
Very well. What is the biggest financial surprises Americans face when they become tax residents in Spain?
I think just failing to understand that things are going to be very different because the complication you have is you'd always have to understand how things work on a US side, but you've now got the Spanish side to think about as well. So you have two completely separate tax systems, which you need to be very aware of how they work, because being ignorant doesn't solve anything at all. And just to give you one example, so in Spain, for example, you've got savings tax where you've got capital gains tax, tax from interest, so things like bonds or savings accounts, and then you've also got dividend tax as well. So they're all combined into one, which isn't really the case in other countries around the world. So understanding those sort of things can be quite overwhelming. And there's also new taxes, so things like wealth tax, which don't exist in the US. Estate taxes as well is very different. So understanding how it works in the US to Spain is completely different because in Spain it's taxed on the beneficiary. So just a lot of things that are completely different to get your head around can make it quite difficult.
How does Spain treat American retirement accounts like 401ks and IRAs? Are withdrawals taxed again in Spain or are there exemptions under the Spanish USA tax treaty?
So Spain will generally always tax on worldwide income, which means that includes foreign assets such as US retirement accounts as well. So the treaty does allow for the US to tax the US retirement accounts in the US, but then Spain taxes it as well and grants a foreign tax credit. So you're not going to be taxed twice, but the tax you will pay is just ordinary income tax, which makes it quite straightforward. So it's not going to be they're not going to look through that and you're going to be paying capital gains tax or anything like that. It's just going to be income tax like what you would pay in the US. But what you can't do is you can't roll these accounts somewhere else. So they're always going to have to stay in the US. You can't move these retirement accounts to a Spanish retirement account. It just has to stay where they are. But yeah, the tax is one thing, but another complication would be the actual restrictions with investments within that, which I'll discuss a bit later on.
Many Americans have Roth IRAs with tax-free growth in the US. Do they stay tax-free once you live in Spain?
No, they don't. So this is where things can be a bit different. So they're not recognised at all, which means they look straight through them, just as if it was a brokerage account. Which means that any withdrawals, etc., they're going to be you're going to be paying capital gains tax as opposed to it being tax free. Um, One thing that you can do that there are opportunities if you are still a US tax resident, because if you compare, for example, the income tax rates versus the capital gains tax rates, which I mentioned before comes under savings tax, it's a much lower rate. So there could be the opportunity, for example, of doing a Roth conversion with traditional IRA accounts as a US tax resident. And this really depends on your personal circumstances. So we need to look at, for example, what your income is in that tax year as the US and what your breakdown of assets are. Because if you are going to breach the higher income tax rate in Spain, and you're not really utilizing anything that falls under savings tax, then there could be an opportunity of doing a Roth conversion so that when you do pay tax in Spain, it's a lower rate. So even though it doesn't come out tax free, it may still be beneficial to, for example, do Roth conversions as a US tax resident to then pay a reduced tax later on.
What happens if someone has a US trust or is a beneficiary of one? And how does the Spanish tax authority, Agencia Tributaria, view foreign trusts?
So trusts are not recognised in Spain as they aren't really across the whole of Europe. And the reason for this is because Spain works off of civil law as opposed to common law. So common law is very straightforward in the US. You can dictate who your assets go to. whereas civil law it's based on forced heirship. So it depends on your family structure. The best thing to do is to close down trust if you are moving to Spain. So you need to find out, for example, if they are revocable, because it just creates more headaches than what it's worth. What people generally use in Spain is life insurance products, and this allows people to just distribute their assets a bit better. But often these products are not available to US connected individuals. Trust is one thing. So a lot of Americans will have living trusts to avoid probate. But of course, if you're living in Spain, you've got probate to think about in two different jurisdictions. So it makes that point really not that important to have it. Whereas the bigger problem is having a trust that isn't recognised. The other part of that, though, is of course the planning around structuring a will. So even though you do have forced heirship rules, you do still have the ability of using an American will as long as it's registered correctly in Spain, and that does give you the ability of, for example, bypassing forced heirship rules and using the rules that you have in the US as long as it is structured correctly. And for that, it's making sure that you can work with an international lawyer that understands how to do that, because it's not a case of just moving to Spain and okay, I've got my will set up in the US. Did that a few years ago. No, it needs to be done in a way that it actually is compliant in Spain.
As a wealth tax and even a solidarity tax. Can you explain how these impact Americans who hold significant assets back home?
Yeah, so it can have quite a big impact, and it depends on the region of where you plan to move. So certain regions will have solidarity tax, but most regions have wealth tax. And there's generally an exemption of 700,000 and then 300,000 for your main residence. And the rates of wealth tax can go all the way up to 3.5%. But it's not just a case of looking at the 3.5% and thinking that's what I'm going to be paying on my total net worth. There are ways to reduce this. So you've got something called the 60% rule, and it's quite complicated to fully break this down. Often it requires working with a tax advisor, and some of the Excel sheets, depending on your assets, can become quite complex. But you need to break down where your income's coming from, and this is, for example, split into two, which is salary income or pension income, and then you've got investment income, so dividends, capital gains, etc. And as long as you don't break this 60% rule on either of those, then you can reduce your wealth tax by up to 80%. So that means that 3.5% doesn't become 3.5% at all. It's the maximum could be 0.7%. And one thing people fail to realize is to avoid or to reduce this completely. So let's just say you do have a significant amount of income that's coming from dividends, for example, and that breaches you above this rate. Well, you could just change your strategy, and you could use, for example, instead of just having direct stocks that pay an income via dividends, you reduce that dividend income and you put it into capital gains tax, because long-term capital gains tax, which is holding an investment for more than 12 months, that then wouldn't fall under this 60% rule. So there are ways to reduce this, especially if people are significantly wealthy, to make sure that you change the investment strategy within your portfolio, and that way, hopefully, we can reduce the wealth tax by 80%. And that's really where us as a financial planning company, that's the planning part. But then the reporting part, that's where the tax advisor would come in as well and just make sure that it is completely correct. But normally people look at the wealth tax and think, no, that's no good. But there's definitely ways to reduce this and not pay those high thresholds.
Let's talk about timing. When should someone start restructuring their wealth before moving to Spain to avoid unnecessary taxation or reporting obligations?
I'd say definitely best to plan at least 12 months in advance, because there's so many things to think about, so many things that you won't be aware of when speaking to, for example, ourselves or speaking to a gestor in Spain as well. But make sure it's planned correctly, because you don't want to do things and then become a Spanish tax resident, because it's not a case of, right, well, if I've set things up whilst I'm in the US, because I'm in the US, it follows US rules. No, you have to make sure that you're a US tax resident if you're taking advantage of specific things that are only available as a US tax resident. If you do move to Spain, it's not to say that that's the worst thing in the world, because a lot of people move and then they don't realize what these problems are. But it then means that you can't exactly move back to then do things that you may have done as a US tax resident. So generally best to plan ahead. And because it can be quite time consuming to go for everything, the more time you've got, the better. So I'd say the sweet spot would be between 12 to 18 months.
And this brings me to a question that I had for our viewers. Like, I would really, really love to understand in which stage of their moving to Spain they are now, like in their projects. Are you, if you want to comment down there, are you just in the planning phase? Are you already gathering documentations for applying for a visa to come to Spain? Are you already like selling your home, or maybe already like just a couple of weeks before moving to Spain? Please comment below, because it's really, really interesting to understand where you are in this process. And also, I remind you that on Spainguru.es you have a moving to Spain checklist, and as Jake has very wisely said, I recommend 12 months in advance going with tax advisors and financial planners, because it's very, very important to have a strategy laid out before moving to Spain.
I was going to add something in there as well. Is we also help clients and then maybe don't even move to Spain at all. So because we have the US regulated business, some people may end up just saying, right, well, this it's too much, or they've got family ties and they decide that the move's not for them. So we still help them as US tax residents as well, but we can structure things so that if they do plan to move in the future, whether that's 5 or 10 years or whatever, they've got things structured in the US as well as if they do move overseas.
How do Americans handle the risk of double taxation? Are the US Spain tax treaties strong enough to protect them?
They are, yeah, but this is the most important thing. They need to make sure they have someone in the US and they have someone in Spain. Avoiding that just creates so many problems. So they need to have someone that's reputable and someone that understands the situation of somebody moving from the US and now becoming a Spanish tax resident. It is hands down the most important thing that an American moving to Spain is going to have to do. As long as things are filed correctly, there's no issues. Of course, if it's not, then that opens up many problems. The one downside with the treaty, and this is often with treaties around the world, it's not just the US treaties, but the US Spanish treaty doesn't cover estate taxes. And this would only impact really, really wealthy Americans because it can lead to double taxation depending on how things are structured. But the US estate tax threshold is just shy of $14 million per individual. And depending on who you gift to, then gifts are unlimited. It can be reduced depending on who exactly you passed it on to. But this creates potential planning opportunities for extremely wealthy Americans to do things whilst they are a US tax resident, because in Spain you do have gift tax, sorry. But yeah, the treaty isn't covered, which means you do have to be very aware of how things work in Spain. And again, this depends on where you're going. Certain regions, there's exemptions. Certain regions, it's really reduced. And certain regions, it's quite punitive. So understanding how the Spanish side works is very, very important.
Jake, what should Americans know about becoming Spanish tax residents? For example, the 183-day rule and what counts as center of economic interest.
Yeah, so it's people often think that the tax residency status is black and white. It's not at all. People could fall into the wrong tax. Sorry, they could fall into being taxed in the wrong country if they don't understand exactly how things work. Because you've got the 183-day rule. If you are in Spain for more than that many days, you are a tax resident. But then it doesn't mean that if you're in Spain for 182 days, you're not a Spanish tax resident. That's not the case at all, because you have to look at where your economic interests are and where your family's based. So if I, for example, I've got a company in Spain, I've got my family in Spain, but I'm just going to move to a country where income tax is tax free. Well, actually, that doesn't mean that I'm going to get my income tax free, because Spain are going to say, no, all of your ties are in Spain. So we're going to tax you here regardless of whether you spent any time here at all. So understanding that point is very important. It applies to businesses as well as individuals. So it's not a case of just you as an individual. There are some quite extreme examples where people think, okay, that's a bit over the top. But no, you need to understand how those rules apply. And if your economic interest is in Spain, that's generally where you're going to be taxed. If your economic interests are somewhere else and you then breach the rules in that country, you may end up having to file taxes there as well. So yeah, it's quite complicated.
Yes, there are many things that I think we need to demystify on how the 183-day rule works for tax residency. One of them is that a lot of people think that spending time as a tourist in Spain doesn't count towards it, but it does. It's actually your physical presence that counts. And some people say like, oh, maybe if only if I am a holder of a residency permit, it will count. But that scouting trip I took at the beginning of the year wouldn't because I was just a tourist. No, this is completely wrong. And also, another one is that people tend to confuse the tax year and the immigration year, that they
Mm,
don't have to necessarily overlap because the tax year is a calendar year from January 1st to December 31st, but the immigration year is a natural year. So if you arrive to Spain holding a, let's say, a residency visa, like
yeah.
non-lucrative visa, etc., on July 2nd, your immigration year goes from July 2nd this year to the next one, right? And they're just like completely different or separated from the tax year. So all those things, I think it is extremely helpful to have someone who knows about this to correctly advise you on the correct strategy so that you don't make expensive mistakes.
I think a common one as well is people just think they can jump around countries and pay no tax at all and just be a digital nomad. So they'd say, right, I love spending time in Spain, but I don't want to pay wealth tax, I don't want to pay tax. I'm just going to spend 182 days in Spain, and then I'll spend the rest of the time dotting around Portugal or Cyprus or Dubai or whatever. But that strategy will never work because from a theoretical point of view, it may sound great, but then if the institutions where your money is sitting with anti-money laundering, especially in Spain, they're so hot on it. I mean, every single year I have to provide all of my tax documents to every single bank, to every single institution where my money sits. There is no way around that. If you provide no tax certificate and you pretend that you're not going to be taxed anywhere, it just will raise alarm bells and it just won't happen. So that is a common one of just pretending that you're not going to be a tax resident anywhere and just below the number of years in one particular country. They'll just look back at your economic ties, and if it's Spain, then that's where you'll be taxed.
Do you see more clients choosing to move investments or keep them in the US? What factors influence that decision from a tax efficiency standpoint?
This has been a really common one over the last year or so, especially people wanting to move their money outside of the US because they're not happy with the way the US is going. But there's so many different complications to moving your money offshore. So as a US person, um, if you were to buy a non-US fund or a non-US ETF, that would be classed as PFIC, which stands for Passive Foreign Investment Company, and this would be taxed at your highest ordinary income tax rate. So as opposed to capital gains tax, it's income tax, which of course nobody wants to pay. And for that reason, a lot of institutions offshore will just close their doors to US persons completely. They also have to do a lot more reporting as well, which makes it complicated for that institution. And unless they're having a sole focus on Americans, it just isn't worth their time. Um, so yeah, generally speaking, there's big restrictions there. But even if you're keeping the money in the US, there's restrictions also. And that's because in Europe, for example, there's regulations surrounding selling US funds and US ETFs to retail clients. And that's because the US documentation isn't the same as Europe, which means that, for example, even the US custodians will restrict US ETFs and funds to Americans, which means the only strategy they may have is buying direct stocks and direct bonds. So if you are, for example, using an offshore platform, but you're just buying direct stocks and direct bonds in the US, you've really got the same exposure because the most important thing is what's the protection on the account itself, not where the money's based. It's the institution which is the most important, and the regulations and the segregation around those assets. So if you were to compare, for example, a US custodian versus an offshore one, that's the comparison you want to do because most of the US custodians hold trillions of dollars versus the offshore ones that are billions. So if there was something to happen to a custodian that has trillions under management, then the whole world is going to probably implode. So I, I see. So what we do is we explain the pros and cons. If somebody wants to keep the money offshore, then that's absolutely fine. But generally speaking, they're paying more money for doing so, and maybe not getting the benefits that they wanted in the first place, because it's just a case of looking at where the assets are based as well, not just the investment platform that they're going to use. So from a tax efficient point of view, Americans are always going to have to file in the US anyway, so they're not exactly avoiding anything anyway, unless it was tax evasion, which no one's going to do. And if they are looking at using an offshore jurisdiction, it needs to be a jurisdiction which is whitelisted, so one that does follow anti-money laundering and tax transparency, because otherwise Europe will see that as a massive negative. And one example is I used to live in the Middle East, so I had an offshore bank account. I think it was based in the Isle of Man, and I remember I tried to send money from Isle of Man from that bank account to my Spanish account. It got flagged, and my bank manager, and this is the only time I've ever been called in by my bank manager or ever had a meeting with a bank manager in my life. He called me into the bank and said, why are you sending money from the Isle of Man? And I said, well, it's just an account I've got. And he said, that's a blacklisted jurisdiction. And I had to provide all of this information to the bank manager. And he treated me as if I was a criminal and said, well, we can't receive the money. And it was more hassle than it was worth. So I ended up just closing that account down completely because it was just pointless. So it's very important to make sure if you are planning to do that, that you use the right jurisdictions. And these jurisdictions generally are only available through financial planners like ourselves.
This brings me to the situation. I see so many Americans, on Spainguru's community, it's a 150,000 member community using ChatGPT to ask these questions. And,
Mm.
they publish those answers, with their best intent to help others, that are asking those questions and everything. And I can see, the huge difference between the real practical implications, you see, of actually knowing what's going on. That's an excellent example. Your Isle of Man account there, then the bank director in Spain just like letting you know that you can't receive that money, etc. I'm sure that artificial intelligence will not give you the right information. You see, it's gonna be nice on paper, everything will be matching, but then the reality will be completely the opposite. So yes, you still need advice from people who are doing this every day, who are facing different situations, that know exactly how things are happening. So yes, this is one other another reason why I think having knowledgeable financial planners is extremely important. The information is not out there as many people can think.
Yeah, so it changed regularly. So the Financial Task Force, they're updating the white, the grey, the blacklist all of the time. Or the countries are changing the rules as well. So, for example, in Portugal, if you were to have your money in Jersey, that's blacklisted and you pay a higher tax rate. And if you didn't know that, and I remember speaking to someone a couple of years ago that had all of the money in Jersey, and I said, you do realize you're now going to pay a higher tax rate because your money's sitting there. And it's not like the institution is going to turn around and tell them that. It has to come from either someone that's dealing with their taxes or a financial planner that's very aware of this. So yeah, having working with someone that's always getting these updates is very important because that list is forever changing.
Absolutely. It is so dynamic. The other day, I was learning that, Panama here, Panama is a country that here is very famous because of the Panama Papers. You see, it was let's say, a fiscal paradise that many famous people had money there. There was no reporting or anything with Spain, but that has actually changed. Now, Panama is a transparent country, that shares information with Spain, that has a double taxation treaty. I was surprised to hear this, you see, because it was something that was in the back of my head, but I just wasn't updated. It's impossible for me. That's not my job to stay updated about all these changes. I think it's very, very important that you manage updated, fresh information before taking decisions on your plan, on your financial planning. Do you agree?
Yeah, definitely. Because you got, I mean, especially with automation, AI these days, the days of hiding your assets offshore are gone. You've got common reporting standards, which means institutions speak to each other from different jurisdictions. And if you're not on that, if you're not on that list, the CRS list, then it's a jurisdiction that you don't want to touch at all. Countries, of course, want to make sure that they're on the white list because then they're getting more money from different institutions or different private investors or clients around the world because they want to be a jurisdiction where people want to keep their wealth. The ones that are not are often these really small Caribbean or Pacific countries where they are pretty much blacklisted around the world, and those ones are just best to completely avoid.
Can you please explain what SJB Global can do for people moving to Spain?
Yeah, there is often quite a lot of confusion. So just explain us firstly. So we're an international financial planning company, and we specialize in cross-border advice. And there is crossover with that, with, for example, a tax accountant or a tax advisor, but we all do a completely separate job and we complement each other with what we do. So for us, we're just making sure that we're setting things up in a tax efficient way based on the assets that we're managing, but we don't actually do the tax reporting or filing the tax returns. So that's where, for example, you get Hestor in Spain, which will do the Spanish side. And if you are American, then you're going to have someone doing the US side as well. And then for us, it's just making sure that we communicate with those tax advisors and accountants to make sure everything comes together. It's very difficult to fully explain it in a simple way, but I guess one example I could give, which I'll discuss a bit later on, is wealth tax. So we're not actually doing the filing for wealth tax, but we can structure people's assets to make sure they can have a reduced wealth tax depending on how many assets they have. So for us, it's more the planning as opposed to the actual reporting.
Is there one single person who is an expert CPA in the States and also in Spain? Does that person really exist, or is it more common among your customers that they use one for Spain and one from the US and that they, communicate?
Yeah, it's way more common to have it separately. I'm yet to really find a big company that would do it together. So generally speaking, yeah, you're going to have a tax attorney in the US and one in Spain, which means, of course, you've got more communication to think of, and it just makes things a bit more complicated. But that's generally how it does work, having one in both countries.
Finally, what's your top piece of advice for Americans planning to retire or work remotely from Spain when it comes to financial and tax planning?
So it can be overwhelming. So it's just best to work with professionals that know what they're doing. The Hacienda, which is the Spanish tax authorities, are as sharp as a tack, and generally nothing gets past them. So yeah, you need to make sure that everything's crystal clear when moving to Spain. And the big thing for us in helping Americans is making sure that your investment accounts, your brokerage accounts, and your retirement accounts are actually aligned to the rules in Spain, because often you could move, for example, and then your custodian turns around and says, right, we can't keep you in Spain anymore. You've got to find a new custodian within 90 days. Those are problems we want to avoid completely, and understanding what the investment restrictions are as well, because you could have, for example, all of your assets structured in US ETFs and funds, but then all of the dividends get paid out in cash and can't be reinvested. So there's loads of things that probably you won't be aware of that you need to be aware of when moving to Spain so that things are aligned correctly. And that's really working with professionals like ourselves to make sure that we can run through that for you.
Jakes, thank you so much for being today with us.
Thank you.
Oh, and one more thing. Apparently YouTube says you're gonna love watching this video right here. I think you should watch it.